Imagine you're sitting at a restaurant in America. The bill is $100. You pull out your credit card, tap it, and walk away. For you, it's just a $100 dinner. But behind that one transaction, something much bigger is happening. Money is moving between you, the restaurant, a bank, and a payment network. And the strange part is, the credit card company doesn't necessarily need you to pay interest to make money from that $100 purchase. So how does the system actually work? And why are credit card companies willing to give you cash back, airline miles, points, and even sign-up bonuses? The answer is surprisingly simple. Your spending is the business. Americans don't just use credit cards occasionally, they use them constantly. At the beginning of 2026, U.S. households had about $1.25 trillion in credit card balances, according to the Federal Reserve Bank of New York. And total U.S. household debt reached approximately $18.8 trillion in the first quarter of 2026. Credit card balances were actually down by about $25 billion during that quarter. But compared with a year earlier, credit card debt was still $70 billion higher. So let's go back to that $100 dinner. You tap your card. The restaurant doesn't simply receive the full $100. The payment goes through a complicated network involving the merchant, the card issuer, and the payment network. One important source of revenue is called interchange income. It's essentially a fee associated with processing the transaction, paid through the merchant side of the payment system. According to CFPB analysis, interchange income for general-purpose credit card issuers was about 1.8% of purchase volume in 2022. That means that even when you pay your balance in full, the financial system can still make money from your spending. Imagine you spend $3,000 on your credit card this month, and at the end of the month, you pay the entire $3,000. You may think, I didn't pay the bank any interest, so the bank made nothing from me. Not exactly. Your purchases generated transaction activity, and the issuer can earn interchange-related revenue. But the real money begins when you don't pay the entire balance. Suppose instead, you carry a $3,000 balance. Now the bank can charge interest, and today's credit card interest rates are extremely high. The CFPB reported that in 2024, the average APR reached 25.2% for general-purpose credit cards. For private label retail cards, the average was even higher at 31.3%. For new general-purpose accounts opened in 2024, the average APR was 27.5%. At those rates, carrying a balance can become expensive very quickly, and millions of Americans do carry balances. The CFPB found that around 50% of accounts revolved balances in 2024, meaning those consumers didn't pay their balances off completely. Even more striking, about 15% of general-purpose cardholders made only the minimum payment. That tiny minimum payment can make the debt feel manageable. And the numbers get enormous. In 2024, consumers were charged approximately $160 billion in credit card interest. That's up from about $105 billion in 2022. Consumers also paid around $31.3 billion in fees in 2024. Think about what that means. Interest and fees alone represented roughly $191 billion charged to consumers in 1 year. That's not the revenue of one company, it's the scale of an entire industry. And this is why the credit card business is so powerful. The company doesn't need every customer to carry debt. It needs a large enough number of customers to do it. Here's the part that confuses people. Your credit card offers 2% cash back, 3% cash back, airline miles, hotel points, maybe even a $500 sign-up bonus.
There it is, $500.
Why would a bank give you money just for spending money? Because rewards can encourage you to use the card more. And more spending can generate more transaction revenue. Meanwhile, some customers pay interest on revolving balances. It's a business model built around different types of customers behaving differently. One customer pays everything off every month. Another carries a balance. Another pays annual fees. Another uses a promotional offer. Another eventually pays late fees. The bank doesn't need every customer to be profitable in exactly the same way. It looks at the economics of the portfolio as a whole, and that is one reason the industry can afford to give some customers generous rewards. But there is another side. Credit cards aren't just about interest. They're also incredibly useful financial products for banks because they create a long-term relationship with customers. Once a person has a credit card, the bank may eventually sell or offer other financial products: a checking account, a savings account, a personal loan, an auto loan, a mortgage, investment products. The credit card can become the front door to a much larger financial relationship, and the competition is enormous. The CFPB's 2025 review of the credit card market found that major credit card companies generated substantial revenue from interest, while interchange and fee income were also important parts of the business. But there's a darker side. Credit cards can be incredibly useful when used responsibly, but the same system that gives you convenience can become expensive when you continuously carry debt. The CFPB reported that the average monthly credit card balance per cardholder reached about $5,300 in 2024. And consumers with prime credit scores averaged even more, about $8,700. That doesn't mean every person owes that amount. It's an average across the relevant cardholder population, but it shows just how large the balances have become. And in the first quarter of 2026, the New York Fed reported that 7.1% of credit card balances flowed into serious delinquency, defined as 90 days or more delinquent. So the same card that can give you convenience, rewards, and purchase protection can also become extremely expensive if the balance starts growing faster than you can repay it. So let's go back to that $100 dinner. You tap your card. The restaurant gets paid. The payment network processes the transaction. The card issuer can earn money from transaction-related fees. And if you carry the balance, the issuer can earn interest. If you pay an annual fee, that's another source of revenue. If you miss payments or incur other permitted charges, there can be additional fee revenue. And if you keep using the card, the bank gets more opportunities to earn from your financial activity. That's why the credit card isn't really the product. Your financial behavior is the product being monetized. And that's the hidden business behind the piece of plastic or the number stored in your phone that you tap every day. The next time you buy a $100 dinner with a credit card, Don't just ask, what did I buy? Ask, who made money from that transaction?